What is the most tax efficient way to pay yourself? It's not a lot, and you're going to be surprised. So we're going to talk through a variety of topics. Number one is why how you pay yourself matters so much. Number two, the biggest common mistakes business owners make in their compensation, and then I'm going to add your family's compensation. And number three, how do you structure your compensation right now? So let's begin with some definitions. In here, the most tax efficient way to pay yourself depends completely on the entity type. So are you an S Corp, an LLC, a limited partnership? Right? What are you? And the principle across everything we teach is true. The most minimal amount you can pay yourself, because companies make the money and have all the deductions, you get taxed. So the least amount you can pay yourself into your personal bank account, the better. So why how you pay yourself matters so much is every entity carries a different, weight to it. So for example, in an LLC, you have a manager and a member. You may have a distribution. You may be employed there. That's not really where a lot of people are employed. Not necessarily. They could be. Depends how you're taxing it. See, the basis of a lot of how you pay yourself is how the company's structured and how the company pays itself. Then there's also, do you have a lot of employees over there? That matters how you pay yourself. S Corps allow you to split the income by salaries and distributions. Now, I'm not a huge fan necessarily of distributions. In the beginning, they're necessary, but as you grow, then it just becomes another taxable event. And then in the case that you want to go get a loan or you actually want to get health insurance, you have to show your entire S Corp's income. So if your S Corp makes $1 million, then you have to show that to, say, your healthcare plan. And instead of having just a small salary, like I have a $42,000 salary. So my daughter and I have immaculate healthcare because I don't make hardly any money. And my healthcare is based on my salary alone, not everything that my S Corp or my LLC would make. In the Put More Cash in Your Pocketbook, I teach a lot about how you pay yourself as an employee from your company. What makes it efficient is what the IRS code says. Some of these strategies, you just follow the code. So A, you have to have a legal intent to make money. And number two, you have to pay yourself a reasonable salary. Well, if you're doing things that outside of being an engineer, a doctor, a lawyer, then that's up to you how you want to pay yourself. So I'm a pretty high revenue earner. I'm not going to say income earner. I create a lot of revenue. But why do I only pay myself $42,000? Because the companies and the way that they're structured are structured in a way that they get the deductions, meaning they pay most of my bills. Like I don't pay for a phone, me personally. I don't pay for a vehicle. I don't pay for an office. I, Laurel, don't pay for those things. The companies pay. So the better your structure is, the better your deduction structure is going to be. Now, the most common mistakes that business owners make in their compensation, they pay themselves too much because they don't know how to get the money into the company. So in the beginning, when your company's first formed and it's not making the kind of money to pay all the bills and all the deductions that you're moving over there, then you have to either do one of two things. You either loan the money, of which when the company's making money will pay you back, or it's yours anyway. You're doing what's called shareholder equity. So you're buying equity into your company. So you're basically funding the company to be able to pay all those bills. The other big mistake is when you take your income through an owner draw. You don't even do a distribution. I mean, it's called a distribution, but you take it through an owner draw. Now you're affecting your balance sheet. There are so many mistakes we see business owners that don't have proper tax counsel make. And if you don't have a really good bookkeeper, now I'm going through and I've trained a whole bunch of bookkeepers in our community to service those of you who really need a good bookkeeper and to get organized. If you go to askbookkeepingcoach.com, I have an 8-week course over there where you can start understanding finance for non-finance business people, because some of you don't know enough to even lead your business, much less lead a bookkeeper or a tax strategist. So go check that out and see if that's going to work for you. So what happens when your salary goes wrong? You paid too much? Well, you paid too much in taxes. So when you make money as a W-2, right, you're paid. You're going to have a consequence right away, and then you got to live on what's left. So you want to keep as much money into those companies as you can so you can activate the deductions, which are all the tax code, and you pay tax at the last minute. Also, as you start earning $250,000, $500,000, you're going to start getting more and more corporate structure. So with this company, Integrated Wealth Systems, and you go check out my website anytime you want, integratedwealthsystems.com, take my quiz, go enjoy some new podcasts we have over there. But when you pay yourself wrong, you're going to get overtaxed. It's just that simple. The other way that you pay yourself a wrong salary and the compensation is wrong is if you are operating the same payroll system. I see this with construction folks a lot. The owner is operating the same payroll system of all the subcontractors, which means all the benefits have to follow suit. Salaries have to be comparable and in line, versus you operate in a different company and have your employees in another company. We'll get more strategic with you, so don't go off and do something crazy just because you watched a 10-minute video on how do you set this up right. Before we continue, I want you here, subscribe to my channel, click the notification button. So 5 days a week, you're getting these videos and content. Listen to them. Grab a journal and write down the video. What are you learning about it? What do you need to do next? Don't just listen and then take action on your own. When you do, what we find with most clients who then come forward a year later or 6 months later, or even 3 days later, is you did something to damage yourself. So the level of tax strategists and corporate structure folks that we have, as far as designing compensation and designing payroll, what you pay yourself, they are like really experts. They go to school, to most of them, to a master's degree of accounting. Then they do all their time. So literally they're doing school and education as much as most surgeons. Basic surgeons only go to school 6 to 8 years, some a little bit longer, but in general, you get my point. My point is you don't do your own surgeries, don't do your own taxes. They're that complicated. Now, is it complicated to learn it? No, but while you're watching Hulu and Netflix and not binging, the right stuff, which should be here, which by the way, I actually reward you for binging here. You can have up to $750 of credit for staying here and binging my challenge. Go through a whole playlist. While you're doing that, we're looking at the IRS code. We're actually activating the tax code in our life by choice and by intention. Most of you are benign to it and you just overpay taxes like, you just can. And you pay yourself wrong. You pay your kids wrong. So let's go to this last point. So how do you structure your compensation to pay yourself the right amount? You work with a tax strategist. You work with somebody who understands what you're doing. You do have to reasonably pay yourself. So I'm going to use a doctor as an example. If we can get you to 100,000, probably not below 100, but if we can get you down in that range, you qualify for a Roth. There's so many benefits to being able to have the lowest payroll compensation possible. Now, some of you, I'll use the doctor as an example, you say, yeah, but I have this huge lifestyle. I know, we're going to look at that. We're going to look at how that house is held. Is it held personally or should it be in a company? Can you have housing allowances? Can you have travel allowances? Can you have technical allowances? Can you have vehicle allowances? Yes, is the answer to all of those. So how we do your compensation is not for you to decide. It's for a tax strategist. And then you want to meet with them on a quarterly basis. So again, the tax efficiency of your salary, once you have a company, is going to be determined by a tax strategist, industry experts. There's industry norms to what you do. There's industry norms to what I do. So again, when you choose to overpay tax and just $10,000 a year, and folks, all of you, you're designed to make more. You're designed to become that millionaire in 3 to 5 years. Every $10,000 that you just casually overpay to the IRS over a 20-year period, invested at 12 and 13%, you'll have given the IRS $1.1 million of your money versus you could have put it to work buying gas and oil, real estate, your own assets, a second property, third property, an apartment, an RV park. It's up to you how you want to play. My job's to teach you there's a different way to play and to be in the alternatives. The healthiest and the wealthiest live in the alternatives. If you have questions, you want to have this activated into your life. You're not going to learn a lot about it. You're going to learn enough to lead them. But our teams will take over and do this for you. Call our office, 775-588-9200, or go to AskLaurel.com, ask a question, make a request. We'll be back tomorrow.